Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. So we are from Group 5 in KMB1 would like to present about a topic which is comparison of conventional and Islamic money and capital market that will discuss and focus on some type of differences like structural differences, instrumental differences, regulatory differences, and many more. Before that, our group is consists of 5 members, including me, Adam Danish. Then we have also SYAHMI, Muhammad IRSYAD, Muhammad AIMAN AQIL, and AKMAL HAFIZ.
Okay, right now we focus on conceptual difference. Okay, in conventional capital market, they focus on profit maximizations and efficiency, which is it operates on the time value of money, where money today is worth more than the money in the future. In the conventional way, they focus on money is treated as a commodity, which is they can use the money to exchange with money. But in the Islamic way, they are using a Sharia law, which is they are prohibited riba. So in Islam, we prohibited riba, and they use money is not a commodity. The money is medium of exchange in Islam. And now we look at permits and speculative derivative. In conventional capital market, they can invest at many type of activities as long as it's legal under civil law. They can invest in tobacco, manufacturing, or they can gambling also in conventional capital market. But in Islamic capital market, there are only you can invest in a investment that Sharia allow, which is cannot invest at the sector like alcohol, pork, or gambling. Okay, right now we look at a structural difference. In a conventional capital market, the conventional financial system is fundamentally debt-based, which is in the money markets rely on a short-term interbank lending through interest-bearing instruments with the goal of managing liquidity efficiently. The overall structure is designed to transfer risk from lenders to borrowers, prioritizing creditor protections, repayment, and certainty. But in the Islamic capital market, in contrast, it's a completely different. The Islamic financial system operates on the asset-backed foundations, which is every transaction must be linked to a tangible asset or actual service. So in the money market, usually we have a mudarabah, which is profit sharing, murabahah, sukuk, and ijarah. Next is in the conventional market, usually them risk transfer based, which is the lenders and the borrowers risk is share. But in Islamic systems, they promote a risk sharing between all parties involved in a transactions. So it maintains a strong connection to real assets, avoiding excessive speculations. They encourage socially responsible investing, ensuring that finance serves both economic and ethical objectivities. This leads to a financial environment that is more balanced, stable, and aligned with a moral and religious values.
My name is Adam Danishbin Ahmad, metric number 1220614. We'll discuss about regulatory differences between conventional and Islamic capital and money market. For conventional market, generally, any company can involve their business dealing with the activities like gambling, alcohol, tobacco, interest-related transaction, as well as other conventional finance. If those transaction, as long as disclosed according to the standard line with proper manner. In contrast, Islam prohibit any one of those activities that deal with a business entity, even large entity like a company, as well as the small businesses like sole proprietorship. Even though to ensure the company or the business is 100% to not involved in any activities mentioned before is nearly impossible, they must commit to minimize as low as possible to be free from any conventional activities. Even if in Malaysia, there is a screening standard outlined by the Sharia Advisory Council by the Security Commission of Malaysia to test whether the equity offered by a company can be considered as a Sharia compliant issuance or not. Next, a nation central bank and authorized security committees supervise the conventional money and capital market that impose law that associate for the market efficiency, investor protection, as well as the transparency of the money and capital market instruments. Those rules are aligned with the perspective of the role of the central bank by the International Monetary Fund (IMF) that focus on aim to preserve sound accounting practices in capital instruments. On the other hand, in Islamic market, the instrument management are supervised additionally to the conventional, with the Islamic authorities like Accounting and Auditing Organization for Islamic Financial Institution AAOIFI, as well as the local authorities that is appointed in certain country in order to make sure that financial instrument offered in a particular country are properly structured, issued, and traded in fully in line with the Sharia principles. Then, for conventional instruments disclosure, the company is just required to disclose all the activities and transactions, as well as to avoid any prohibition stated in adherence to the standards like IFRS, International Organization of the Securities Commission, along with the international adopted local standard like MFRS, which is Malaysia Financial Reporting Standards. Conversely, Islam does not only stress on the annual reporting and prospectus details by the securities issuers, it also considers the requirement capital and the money market instruments that offered to report and ensure the adherence of the Sharia jurisprudence as well as the standards that required by the international and local Islamic authorities. Like in Malaysia, we can follow all the standard outlined by the SAC and internationally by the AAOIFI.
Now, let me walk through the instrumental differences between conventional and Islamic capital markets. In both systems, financial instruments serve the same basic purpose to raise capital, manage liquidity, and invest. However, the underlying principles are completely different. Conventional instruments are typically interest-based, which means they rely heavily on riba. They also allow speculation and uncertainty, known as maisir and gharar, which are strictly prohibited in Islamic finance. On the other hand, Islamic instruments must comply with Sharia principles. This means all transactions must be ethical, asset-backed, and must involve risk sharing instead of interest-based returns. In the conventional market, the most common instruments include equity like ordinary and preferred shares, and debt instruments like bonds, treasury bills, and commercial papers. In the money market, tools like negotiable instruments of deposit and repos are widely used. These instruments are popular because they offer fixed returns, but the issue is they are often disconnected from real economic activity. There's little to no ethical screening involved. Derivatives like options and futures are also used, but this can involve high levels of speculation, which again goes against the Islamic values. Now, let's look at the Islamic instruments, which are much more rooted in the ethics and real assets. In the capital market, the main instruments are, the first one is sukuk, which are similar to bonds, but returns are tied to the performance of real assets. Second, mudarabah and musyarakah, which are profit-sharing contracts, and ijarah, which is a leasing-based investments. For money market, we have instruments like Islamic negotiable instruments of deposits. Second, Islamic accepted bills. Next, sell and buyback agreements, and also BNM issue sukuk, which are short-term and Sharia compliant. The most widely used contract here is commodity murabahah, especially for interbank placements. All of these instruments must pass Sharia screening, ensuring that they are transparent, ethical, and backed by real economic activity.
Alright, we move to the advantages of capital market. We begin with the advantages of conventional and Islamic capital market. For conventional capital market, the point number one is the wide range of financial instrument. This includes stock, bonds, and derivative. Having many options helps investors build flexible portfolios that suit their needs and risk level. And the point number two is high liquidity. In these markets, it's easy for investor to enter or exit trades. So this makes the market more efficient and give more people confidence to invest. And next is efficient price discovery. This means the price of a stock or bond reflects its real value based on current supply and demand. It helps investors make informed decisions. And lastly, strong support for economic growth. Capital market help fund infrastructure projects and business expansion, so which drive national development. For Islamic capital markets, the advantages is number one, that they are Sharia compliance. Like we are Muslim, we need to follow the Sharia compliance. They avoid interest, which is riba, gambling, masyir, and uncertainty, horror. This ensures ethical and socially responsible in investing. Point number two is the use of asset-backed instrument like sukuk. They are tied to the economic activities, not just debt, which keeps finance linked to productive asset. Next is the emphasis on risk sharing. Instead of fixed return, profit and losses are shared fairly, creating more balance and just financial relationship is more better. And number four is lastly is their resilience during downturn. Because of their conservative and asset-based structure, Islamic market often perform better during financial crisis. Alright, next, let's look at the disadvantages of conventional capital market and Islamic capital market. So for conventional capital market, the point number one is the risk of speculative trading. This can create high volatility and even lead to a financial crisis. The point number two is investment in controversial sector. Conventional markets allow trading in areas like gambling, tobacco, or alcohol, which may be seen as unethical by some investor, which is for Muslim investor, and is prohibited. And lastly, point number three is product complexity and equal access. Some financial instruments are difficult to understand, and large investors often have more information than retail investors. This creates unfair advantages. Like look out at the Islamic capital market, the disadvantages is limited range of instruments. Because all products must follow Sharia rules, there are fewer investment options, which reduce diversification. Point number two is differences in Sharia interpretation. Each country or institution may apply Sharia differently, which leads to inconsistent product and make cross-border investment harder. And point number three is a lack of short-term liquidity tools. Islamic financial institutions have fewer instruments to manage short-term funding, and they also face higher compliance cost due to Sharia supervision. And lastly is limited market depth and scalability. Compared to conventional market, Islamic market are still smaller and less liquid, which can discourage larger investors. Next, we move to the challenges for the conventional capital market and Islamic capital market. Alright, for the point number one for the conventional capital market is weak regulatory enforcement. Despite regulation, issues like fraud, insider trading, and manipulation still occur. And next is speculation and high frequency trading. This can create unstable market and increase systematic risk, especially during times of uncertainty. And lastly is global financial contagion. Because conventional markets are highly connected, a crisis in one region can easily spread to others, like war between the Iran and Israel that affecting the global stability. We move to the challenges of Islamic capital market. Point number one is the lack of harmonized Sharia standard, which is different interpretation in different countries, create confusion and reduce investor confidence. And the point number two is limited Sharia compliant liquidity tools. This make it difficult for institutions to manage short-term funding efficiently. And next is regulatory and market fragmentation. Differences in legal system and Sharia governance across countries make it hard to grow and integrate the market. And lastly is lack of expertise and awareness. There are not enough professional trained in Islamic finance, and many investors are still unfamiliar with Islamic capital market product. And to wrap up this slide, conventional market must improve regulation and reduce speculation to avoid future crises. And Islamic market need harmonized Sharia standard, better liquidity tools, and more talent development. Addressing these challenges is important for both systems to grow stronger, more inclusive, and more resilient. That's all for the challenges part.
Approach related to the capital markets. I will begin by explaining the first approach, which are regulatory harmonization and governance standards. One of the biggest challenge in the Islamic capital market is the lack of standardization across countries. Different interpretation of Sharia create inconsistencies, especially in cross-border investment. To address this, international bodies like IFSB were established to develop unified Sharia standards. In Malaysia, the Security Commissions introduced the Sharia Governance Framework in 2022, which defines clear roles for the Sharia Committee, internal audit, and compliance officers. Meanwhile, conventional markets follow broader frameworks like IFRS and ESG compliance. For example, Bursa Malaysia enforced the Sustainability Reporting Guide 2022 to ensure ethical business disclosure. These frameworks promote investors' confidence and transparency across both systems. Moving to the second approach, which is investor education and financial literacy. A major issue in Islamic finance is the low public awareness, which slows down the participation of Sharia compliant market. To improve this, the Security Commission Malaysia launched the Investor Empowerment Strategy 2023 to 2025. This includes Islamic finance modules, workshops, and digital tools to educate the public. In addition, organizations like MIFC and the Islamic Development Bank support outreach programs in universities and communities. This goal is simple. It is to build trust and understanding among retail investors and to make Islamic capital markets more inclusive. And lastly, let's look at the third approach, which is product innovation and fintech integration. Fintech is rapidly transforming both conventional and Islamic markets. On the Islamic side, we are seeing the use of blockchain for smart sukuk, AI-based Sharia screening, and platforms like Wahid Investments, which act as Islamic robo-advisor. There's also rising interest in Islamic DeFi platforms and the tokenization of sukuk, making access easier for a wider population. On the conventional side, tools like algorithmic trading and digital asset tokenization are already in use. These innovations aim to make financial system more ethical, tech-driven, and accessible, which is the shared vision for both capital market systems moving forward.
Alright, for the future direction of the capital market, both conventional and Islamic capital market are undergoing major transform, mainly due to advance in technology, growing awareness of sustainability, and the push for wider financial inclusion. For the conventional capital market, we see a shift from profit-only focus to ESG-aligned investing. Instruments like green bonds, social impact fund, and climate-linked product are increasing. At the same time, fintech tools such as the AI, machine learning, and the robo-advisor are transforming investment decision-making. Regulators are also supporting innovations through regulatory sandbox that allow new financial technologies to be tested safely. Meanwhile, in the Islamic capital market, blockchain and smart contract are being adopted, especially in sukuk, to improve efficiency and compliance. Tokenization and Islamic crowdfunding platform are expanding access. All this Sharia screening help ensure companies stay compliant more accurately and frequently. Islamic DeFi platforms are also emerging, offering interest-free asset-backed investment in a digital environment. Despite this positive development, both markets face challenge. The conventional market must deal with the regulatory uncertainty around digital asset, volatility in crypto, and increasing cybersecurity risks. On the Islamic side, issues like lack of standardization and the inconsistent Sharia interpretation across country make it difficult to develop unified financial product. Looking ahead, both markets are clearly moving toward more digital, transparent, and sustainable system. Although they are based on the different principles, both aim for the future where ethical investment, financial stability, and inclusive participation are the new standard in the global finance. So, in conclusion, what we can see is that even though conventional and Islamic capital and money market operate on very different foundation, conventional market being interest-based and profit-driven, while Islamic market follow Sharia principle, focusing on ethical investing and risk sharing. Both systems actually serve the same core purpose, which is to support economic growth. As time goes on, with more innovations like fintech, better regulations, and improved financial literacy, both markets are starting to align more closely. They are both working toward the same bigger goal: financial stability, inclusive participation, and sustainable development, not just for specific group, but globally.